Welcome to Sheen Research, your strategic partner in uncovering untapped business potential.
Today, we're taking a close look at Lifeway Foods, Inc., which trades under the ticker LWAY.
And we're diving into a really fascinating period for them, a time of, well, just remarkable revenue growth that seems to be shadowed by some pretty significant corporate expenses.
Exactly. Our analysis is going to zero in on LA's most recent public disclosure, which is the Q3 2025 filing. So that's for the period that ended September 30, 2025.
And our mission here is really twofold. First, we're going to summarize all the key financial and qualitative data from that Q3 report. We'll get into all the numbers.
But then, and this is the really critical part of our analysis today, we're going to compare that performance directly with the quarter that came right before it, Q2 2025.
Right, because simple year-over-year comparisons can hide a lot. This sequential or quarter-over-quarter look is what helps us isolate the real trends.
It lets you see how management is really executing, especially during those high-demand summer months, and you can really start to understand the impact of their strategic shifts in near real time.
It's like the difference between seeing a car's average speed over a whole year versus seeing how hard they hit the gas pedal in just the last 3 months.
And what that acceleration cost them.
Okay.
That's the key. This level of detail is, I think, absolutely necessary if you want to get a comprehensive understanding of Lifeway's strategy and where they're heading, especially now.
Especially now with this massive capital expenditure phase they're heading into. So, all right, let's lay the foundation. Let's start with the Q3 2025 performance, looking at it against Q3 of the previous year, 2024.
Okay, so the big headline here is just pure top-line momentum. Lifeway reported net sales of $57,143,000 for the quarter.
And that 57 million figure is genuinely impressive when you put it in context.
It really is. It represents a year-over-year increase of over $11 million.
So that translates into a growth rate of what, 24%?
24%. And, you know, in the consumer packaged goods space, that kind of growth is. It's just not that common.
Yeah.
Especially in a pretty mature category like cultured dairy.
Maintaining a 24% growth rate tells you that their core product, their Kefir, is absolutely resonating with consumers right now.
But here's where it gets even more interesting, and this is a really crucial point. That reported 24% growth, as strong as it is, it actually understates the real story here, which is all about volume-driven demand.
You're talking about management's comparable sales adjustment?
Exactly. We have to adjust for two very specific strategic moves that happened back in late 2024.
Okay, so what were they?
First, Lifeway strategically decided to exit a relationship with a specific customer. That was late Q3 2024. Second, they had a pretty significant distributor shift.
Right, this shift where they moved from a system where Lifeway was delivering to the customer to one where the customer handles the pickup themselves.
And that second point, it can be a bit confusing. Let's break it down.
Yeah, please do. Because when a company does that, when they switch to customer pickup, the reported net sales number actually goes down, right? Why is that?
It goes down because the freight revenue is no longer on their books. It's stripped from the top line. But, and this is the important part, the corresponding freight cost is also eliminated.
So while the net sales figure might look a little lower than it otherwise would, the underlying sales volume, the amount of product actually moving, is still growing.
Precisely. And often the profit margin on those sales gets better. So when management adjusts for both that exited customer and that distributor shift, the true comparable sales growth figure jumps to approximately 29%.
29%. Now that is a serious number.
It's a huge indicator of accelerating volume-led demand. It tells you the product is just flying off the shelves.
That kind of volume should lead to some major efficiencies in their manufacturing process.
And it does. We see that translate immediately when we look at the gross profit line.
Okay, so what was the gross profit?
It reached $16,408,000 in Q3. But more importantly, the gross profit margin expanded in a big way.
It climbed from what? About 25.7% in Q3 of 24?
To 28.7% in this quarter.
Wow, a 300 basis point expansion year over year. That is not trivial at all.
No, it's not. It signals really superior use of their manufacturing assets.
So the higher volumes of their branded products meant they were just running their plants more efficiently, closer to optimal capacity.
That's a huge part of it. Plus, they also benefited from some favorable pricing on conventional milk during the period. That helped keep some of their biggest input costs under control.
Which, as we'll get into later, is always a moving target for them.
Always.
So let's follow that down to the bottom line. What was the net income for Q3 2025?
Net income was $3,529,000, a really healthy increase from the $2.97 million they did in the prior year.
And earnings per share?
Basic EPS came in at 23 cents, up from 20. And diluted EPS was also 23 cents, up from 19 cents last year.
So just solid financial growth across the board, at least on a year-over-year basis?
Definitely. But given that growth, it's really critical to remember how concentrated Lifeway's business is.
Right. They operate as a single segment, basically. Just cultured dairy products.
And the sales mix really confirms where all the energy is focused.
Let's break that down then. The flagship product, their drinkable kefir, and this is excluding the kids' ProBugs line, that's the absolute engine of the company, isn't it?
It's everything. It accounted for a massive $49,596,000 in net sales.
That's what, 86% of total net sales?
86%. It's an overwhelming concentration. I mean, for all intents and purposes, this is a kefir company.
What about the other sort of ancillary categories?
They're pretty minor in comparison. Cheese was the next largest at about $4 million, so 7% of sales. Cream and other was about $2.1 million, so 4%. And then the rest, the drinkable yogurt, the ProBugs line, other dairy, all of that combined is just 3% of sales.
That is a sharp concentration. It's a bit of a double-edged sword, I'd imagine.
It is. On the one hand, you have this superb focus on your market-leading product. On the other, you have a very high reliance on that single product's ongoing success.
And speaking of reliance, we have to talk about customer concentration too.
Yes. For Q3 2025, two major customers accounted for 23% of net sales.
23% from just two customers.
That's just the reality of the CPG landscape when you're dealing with huge grocery chains and distributors. But it also means that any disruption, any strategic change with just one of those two, like that exited relationship we talked about, it can fundamentally change your quarterly performance.
It adds this layer of execution risk that they constantly have to manage. Okay, so let's move beyond the income statement for a minute. Q3 2025 was really defined by some bold, forward-looking strategic moves. Capital deployment that shows management is trying to lock in future growth.
And the most visible initiative is that massive expansion at their Waukesha facility.
This is Lifeway making a huge bet on their capacity, isn't it?
Yeah.
It's not just an incremental upgrade.
No, not at all. This is a capital expenditure program designed to literally double their manufacturing capacity and triple their bottling speed at the Waukesha, Wisconsin facility.
This isn't just about getting some new equipment. It's like they're building an entirely new foundation to allow for future scale.
You've hit the nail on the head, and the numbers really confirm the scale of that ambition. The total project is estimated to cost $45 million.
A $45 million price tag. And as of the end of Q3, they've already paid out, what, $6.1 million in cash towards that?
Correct. And the whole thing isn't expected to be finished until the fourth quarter of 2026.
The timeline and the cost, they seem directly linked to the aggressive future guidance the company's put out there.
They have to be. By committing $45 million over the next couple of years, management is signaling very clearly that they believe that 29% comparable sales growth is sustainable.
And they need to future-proof their entire manufacturing process to meet that projected demand.
Right. They're trying to solve for their biggest bottleneck.
But capacity is only one side of that equation. You also have to secure the inputs.
And that brings us to the full implementation in Q3 of their new organic milk supply strategy, which is probably the most unique and fascinating item in their filing. It's known as the herd.
Yeah, I saw that. When you first read that Lifeway has purchased 402 mature dairy cows, you might think you've picked up a farming report by mistake.
Exactly. But this is actually a highly sophisticated financial strategy. It's designed to mitigate the volatility in their supply chain for their most critical input, organic milk.
So how does owning a bunch of cows help a major public food company? What's the mechanism here?
Well, it creates control without the operational headache of actually running a farm. So Lifeway purchased these 402 cows in Q3 for $1,335,000.
But they don't manage the farm themselves.
No. Instead, the herd is managed by a third-party dairy. It's all under what's called the herd agreement, which spans 60 months. 5 full years.
So Lifeway secures the organic milk source by owning the assets, the cows, and then just contracts out the day-to-day management.
Precisely. And they have a separate supply agreement with a cooperative of farms to purchase the milk that's produced by this specific herd.
So it's really about securing that supply.
It is, but there's a critical accounting nuance here, too. The herd agreement is structured as a sale of non-financial assets back to the dairy, which will generate interest income for Lifeway over that 60-month term.
Ah, okay. So this structure secures their long-term organic supply, gives them stability, and it also generates a return on the capital they deployed.
Right, and the payments from the dairy on that are scheduled to start on December 1st, 2025.
This sounds less like a farming initiative and more like a supply chain insurance policy against commodity price volatility.
That's a great way to put it. It's a creative way to mitigate risk, and it shows up as an investing outflow on the balance sheet. It really demonstrates a willingness to use their capital in non-traditional ways to lock in profitability down the road.
Okay, now we have to turn to corporate governance and the ongoing saga with the unsolicited purchase proposal from Danone, because this had a very real, measurable financial impact in Q3.
It absolutely did, and it highlights a major non-operational challenge that management is dealing with. The first measure they took was to extend their shareholder rights plan.
Can you explain the rights agreement? The poison pill for anyone listening who might not be familiar with this kind of strategic defense.
Sure. You can think of it as a deterrent. It's designed to make an unsolicited takeover attempt prohibitively expensive, or at least very complicated, for the acquirer.
It's a defensive move.
Exactly. The original agreement was set to expire in November 2025, but management extended it to October 2026. This basically sends a signal to Danone, or any other potential hostile bidder, that the board is committed to defending the company's independence for at least another year.
And this defense mechanism, while it's crucial for protecting shareholder interests from what they might see as an opportunistic bid, it comes at a cost that directly hits the bottom line we were just talking about.
A very significant cost. The company incurred professional fees of $2,400,000 just in Q3 2025 alone.
$2.4 million.
Yeah.
And that was all related to the Danone proposal and the associated stockholder action.
Yes. And the cumulative cost for that action for the year to date?
What was it?
$4,300,000 through 9 months. This non-routine expense is the key distorting factor when we get into the sequential net income analysis.
It's a necessary cost of doing business and defending the company, but it absolutely masks the underlying operational profitability they're generating. Okay, finally, before we transition, let's just quickly check on Lifeway's financial health, which, despite these costs, appears pretty robust.
It does. Cash and cash equivalents stood strong at nearly $23 million at the end of Q3. That's a solid increase from the $16.7 million they had at the end of 2024.
And their liquidity profile looks excellent.
It is. They have $0 outstanding on their revolving credit facility. That means they have $25 million in immediately available borrowing capacity.
So that combination, significant cash on hand plus available credit, it confirms they're very well capitalized.
Very well. And they also confirm they're in compliance with all their debt covenants.
Can you just break that down in plain English? What does being in compliance with the fixed charge coverage ratio and the maximum cash flow leverage ratio actually mean for the business?
It just means they're financially very secure. The fixed charge coverage ratio proves they're generating more than enough operating income to comfortably cover their fixed costs, like interest payments. It shows they can service their debt.
And the leverage ratio.
That just confirms their total debt is very small relative to the cash they generate. They're not over-leveraged and could easily pay down their obligations if they needed to.
So they're financially sound and well-positioned to fund that massive CapEx program themselves.
That's the bottom line.
That sets the stage perfectly. We've got record revenue, expanding margins, massive capital plans, this unique strategy for input control, and a major corporate defense underway. Now let's get to the core mission. The sequential comparison of Q3 versus Q2.
This is where the story really gets nuanced. We know the top line is accelerating. Q3 net sales, as we said, hit $57.1 million.
And compared to Q2 2025 net sales of $53.9 million, that represents a sequential increase of about $3.2 million.
Which is roughly 6% sequential revenue growth.
That's just stellar execution. They were delivering on the volume acceleration they promised, capitalizing on that summer demand and the underlying consumer trends.
The top-line performance is, without a doubt, a success. But now let's introduce the conflict. We have to look at the bottom line.
Okay.
Q3 2025 net income was $3,529,000. Now compare that to Q2 2025 net income of $4,249,000.
So wait, despite having higher sales and higher gross profit dollars, their net income actually dropped by $720,000 from Q2 to Q3.
It did, a steep decline of about 17%.
And this is the central puzzle we have to solve. Why did profit fall, even as revenue was hitting a record high?
And the answer lies entirely in their non-core cost structure. But first, we need to confirm the underlying operational stability.
Okay, so we do that by looking at the gross margin quarter over quarter.
Exactly. The Q3 gross margin was 28.7%. Q2 was 28.6%.
So they're basically flat. A 10 basis point move is negligible.
It's negligible, and it's fantastic news for the core business. It confirms that their underlying manufacturing processes, their raw material cost management, all of that was handled expertly.
The stability was driven by those higher volumes, giving them efficiencies, and the favorable conventional milk prices.
Right, which successfully counteracted some of the pressure they were seeing from unfavorable organic milk prices. So the core business is strong.
Okay, so if the cost of goods sold is under control, the profit drop has to be coming from operating expenses, or OpEx.
That is precisely correct. We see a significant jump on the OpEx line. Total operating expenses in Q3 were $11,368,000.
And in Q2?
In Q2, that total was $9,605,000.
So that's a sequential increase of $1.76 million.
It is.
$1.76 million more in quarterly operating expenses. That surge completely ate up all the profits from the $3.2 million in higher sales. So where did that money go?
To find out, we look directly at the general and administrative expense line, G&A.
Okay.
Q3 2025 G&A was $6,186,000. Compare that to Q2's G&A of $4,752,000.
The G&A expense increased by $1.43 million. That's almost the entire OpEx jump right there.
It is. And we know exactly what drove that. It was the $2.4 million in professional fees related to the Danone proposal that they booked in Q3.
So if you strip out those non-recurring legal and professional fees, the G&A expense would have actually been much lower than Q2, operationally speaking.
That's the crucial finding. If you conceptually normalize that $6.186 million G&A expense by removing the $2.4 million in fees, the underlying operational G&A was roughly $3.786 million.
Which means their operational G&A actually declined sequentially by almost $1 million compared to Q2.
Yes. The operational efficiency improved dramatically, but those corporate defense fees completely masked all of that hard-won gain.
And that difference in expense is why operating income declined, despite the higher revenue.
Exactly. Q3 operating income was $5,040,000, which is down about $755,000 from Q2.
So this quarter is a textbook example of a company with accelerating sales and improving core profitability, having its bottom line just torpedoed by essential yet non-operational legal costs.
It is. Now, separately, let's look at the more routine costs, like selling expenses. This really reflects their commitment to marketing, which is the engine driving this volume surge.
Right. Q3 selling expense was just over $5 million, which is about 8.8% of their net sales.
And in Q2, it was about $4.7 million, or 8.7% of sales.
The total spend and the percentage of sales both ticked up slightly.
And that's consistent with a company that's in growth mode. They're investing heavily in marketing to sustain that volume momentum. It shows they aren't cutting back on growth investment, even with those massive legal fees.
Okay, let's shift gears from net income to cash generation. But so that tells a much more optimistic story about their operational health. We need to figure out the cash flow from operating activities just for Q3.
Right, and since they report year-to-date numbers, we have to do a quick subtraction. For the 9 months ending September 30, the YTD operating cash flow was $10,681,000.
Okay. And we know that for the first 6 months ending June 30, the YTD figure was $3,762,000.
So by calculating the difference, we find that Q3 alone generated $6,919,000 in cash from operating activities.
Nearly $7 million. That is a colossal sequential acceleration, a huge positive sign.
It is. To put that in context, Q1 of this year had negative operating cash flow, minus $150,000. Q2 showed a strong recovery, generating about $3.9 million.
And then Q3 just exploded to nearly $7 million in cash from operations.
This surge in cash flow, it validates the underlying efficiency gains and the impact of all that volume. It proves that the business model is highly cash generative when it's not being held back by working capital needs from earlier in the year.
And that strong cash generation is what's feeding their aggressive CapEx plans.
Let's look at the cash outflow for investing activities, specifically the purchases of property and equipment for that Waukesha expansion.
Okay.
This is where we see management's execution really matching their strategic talk. Year-to-date CapEx through September 30 was $9.675 million. We know that the first half of the year totaled $4.526 million.
Which means Q3 alone saw a massive cash outflow for property and equipment of about $5.15 million.
And that figure is more than double the Q2 CapEx outlay of $2.3 million.
So this is the clearest evidence of execution we can find. The Waukesha project isn't stalled, it's accelerating and accelerating rapidly.
They're moving from planning and early-stage spending to major physical deployment in the third quarter. They are putting that surging operating cash flow to work building their future.
So to summarize this section, revenue grew sequentially by 6%. Operational gross margins held stable. Cash flow from operations surged dramatically to almost $7 million.
But net income dropped by 17%, and that drop was solely due to that massive, non-recurring $2.4 million professional fee tied to the corporate action.
The company is demonstrably healthy operationally, but it's facing this multi-million-dollar, call it a distraction tax.
A very good way to put it.
Now we need to contextualize these numbers by looking at the broader strategic narrative that management has been laying out, starting with the confidence they expressed back in Q2.
Right. Back in the Q2 materials and commentary, management was already projecting very strong Q3 momentum. They even cited an unaudited sales number of $26.4 million through August 11, noting it was up over 20% year over year at that point.
And crucially, they reiterated their extremely ambitious long-term target, $45 to $50 million in adjusted EBITDA for fiscal year 2027.
And Q3's results absolutely validated that near-term confidence. The revenue growth confirmed the strong momentum they promised. The market is clearly responding to the brand and the category.
But the shadow over that confidence, as we've been discussing, is this massive cost structure associated with defending the company. How much of a distraction is this corporate action, really?
I think it's a major diversion of resources. The situation was formalized in Q3 with a cooperation agreement dated September 30th. That just underscores that management was spending substantial time and money on this defense while simultaneously trying to run a business growing at 29%.
$2.4 million in a single quarter for legal and professional services. That is a colossal use of cash that could have gone to marketing or R&D or even accelerating the CapEx more.
No question. And the extension of the shareholder rights plan to late 2026, it confirms that management doesn't see this as a short-term issue.
They're investing heavily to control the outcome, which tells you that preserving shareholder value right now requires spending millions in defense fees.
It confirms a very complex operating environment, high growth, high capital spending, and high corporate litigation risk.
Let's pivot back to that herd initiative, the organic milk strategy, because this thing progressed really quickly from just being mentioned as a subsequent event in Q2 to being a fully implemented strategy in Q3.
It did. The commitment deepens significantly. The Q2 filing mentioned the initial purchase of 224 cows in July for about $700,000. By Q3, they had finalized the whole strategy, buying another 402 cows for $1.3 million.
So the total investment is substantial and it seems to be growing. And the duration of the agreement changed as well, didn't it?
It did, which really changes the long-term outlook. The initial Q2 disclosure mentioned a 39-month agreement. The Q3 filing confirmed it was amended to a 60-month term.
5 years.
Extending that commitment by over 2 years signals that securing organic input stability is a 5-year priority for them. It's directly linked to securing the margins they need to hit that 2027 EBITDA target.
This shift from just being a buyer in the organic milk market to actively investing in the source of supply is a very creative way to use their strong liquidity. It's a defensive move.
It's strategic capital deployment at its best. They are essentially buying long-term stability in a volatile commodity market,
Ensuring that even if organic milk prices surge everywhere else, they have a secure, fixed-rate source for a key component of the product that makes up 86% of their revenue.
Exactly.
Let's reinforce the market and industry trends that are driving all this strong demand. It's really about this consumer focus on functional foods.
The core narrative is very consistent. There's this massive, sustained consumer focus on health, wellness, and especially foods that are rich in protein and probiotics. Kefir fits that trend perfectly.
And Lifeway specifically called out the surge in GLP-1 medication use in prior commentary. That trend seems to be a major tailwind for them.
It really is.
How does that trend, these medications for weight management and blood sugar, how does that specifically drive demand for kefir?
Well, these medications often reduce appetite and can sometimes cause GI distress. That makes it critical for users to focus on nutrient-dense foods. They need high protein for satiety and muscle maintenance, and beneficial probiotics for gut health.
And kefir, being a high-protein, probiotic-rich drink, just perfectly addresses both of those needs.
It transforms their product from just a general health food into an essential dietary aid for a growing segment of the population.
But not every product in their portfolio is benefiting equally from this. We saw a pretty stark divergence in performance.
That's a very important point. While the drinkable kefir is surging, other categories like drinkable yogurt and ProBugs saw their sales contributions go down both sequentially and year over year.
The drinkable yogurt sales were almost halved, weren't they?
Yes. Fell from about 1.5 million in Q3 of last year to just 668,000 in this quarter. ProBugs saw a similar steep decline.
So does this divergence signal a weakness, or is this management just intentionally streamlining their focus?
I think it suggests the latter. It seems like management is either actively or passively letting resources flow disproportionately to the core product kefir and the high-protein cheese offerings.
Which is smart strategy. Why try to sustain declining legacy lines when you can focus all your marketing and manufacturing power on the 86% revenue driver?
Right. It increases profitability, and it simplifies execution ahead of that massive Waukesha expansion.
So let's evaluate management's execution on their overall strategy. They had two huge priorities in Q3: drive sales volume and accelerate CapEx.
And they executed strongly on both fronts. We already saw the CapEx acceleration more than doubling Q3 spending versus Q2. The Waukesha project is on track. And crucially, they maintained those gross margins at 28.7% despite commodity price volatility.
That shows exceptional execution in procurement and manufacturing.
It does. They're successfully blending the benefits of favorable conventional milk pricing against the headwinds of organic milk prices.
And what about their commitment to the shareholder base? How did that look?
Total stockholders' equity increased significantly. It went up to $82.7 million in Q3 from $78.7 million in Q2.
And that increase is driven primarily by retaining that $3.5 million in net income.
That and some stock-based compensation activity. Moreover, that extension of the rights agreement really underscores their focus on protecting the interests of the current shareholder base from that unsolicited takeover proposal.
Finally, let's just revisit the risks. We know the corporate distraction is quantified at $2.4 million in Q3, but what about the persistent macroeconomic risks?
The general risks they cite in both Q2 and Q3 are pretty consistent. Inflation in key input costs, ongoing supply chain complexity, commodity volatility.
They're trying to mitigate the organic milk piece with the herd strategy, but the risk remains broad-based across things like energy, packaging, and labor.
It does.
I have to push back a little on management's implied tone of confidence here. I mean, while the revenue figures are great and they support optimism, doesn't that $2.4 million defense cost suggest a potentially long and expensive corporate battle that could derail the focus they need to pull off a $45 million CapEx project?
That is the critical challenge. The tone of management, which you can infer from the filing and their reiteration of that 2027 target, it suggests they view the Danone action as a necessary but finite distraction. They seem confident they can multitask, run the business, and fend off the acquirer at the same time.
But you're right to question it. That G&A spike highlights a significant real-world pressure point. If that litigation drags on, those non-operational costs will continue to weigh heavily on net income.
And that will make their otherwise strong operational performance look less robust to outside observers.
So it's a test of whether they can walk and chew gum at the same time. Or rather, whether they can triple their bottling speed while fighting a hostile takeover attempt.
A fascinating and expensive high-wire act indeed. The next few quarters are going to be defined by the success of that CapEx acceleration and the duration of that $2.4 million quarterly expense.
We've reached the end of this quantitative and qualitative analysis of Lifeway Foods' Q3 2025 performance. To synthesize the key findings, LWAY is operationally hitting on all cylinders.
They achieved record net sales of $57.1 million, backed by 29% comparable growth and very stable gross margins at 28.7%.
The core business momentum is just undeniable, and the cash machine is robust. It generated nearly $7 million in operating cash flow in Q3 alone.
But that operational success story was entirely masked by the costs of corporate defense. Sequential net income dropped 17%, and it was solely due to that $2.4 million in non-recurring professional fees related to the Danone proposal.
Lifeway's liquidity position, $23 million in cash, $25 million in available credit, is allowing them to aggressively fund their two major long-term strategic bets.
That $45 million Waukesha capacity expansion project is visibly accelerating, with CapEx spending doubling in Q3 versus Q2.
And their unique approach to input control, the purchase of the herd of dairy cows for over $1 million under a new 5-year agreement, it shows an executive team willing to invest capital strategically to mitigate supply chain risk over the long term.
So we'll leave you with this provocative thought, which is really the ultimate connection between their current actions and their future goals.
Lifeway Foods has publicly committed to achieving an aggressive adjusted EBITDA target of $45 to $50 million by fiscal year 2027. This target requires not just higher sales, but sustained high-margin profitability.
So given the substantial long-term investments they are making in capacity expansion with Waukesha and, critically, supply chain control with the 5-year herd agreement, just consider how essential total control over their organic milk inputs must be to securing that massive profitability goal.
The CapEx and the cow purchases aren't just investments. They seem to be preconditions for hitting $50 million in EBITDA.
The success of this high-growth story hinges entirely on the health of a Wisconsin factory and the sustained production of 402 dairy cows.
The definition of strategic capital deployment in cultured dairy.
Indeed.
Thank you for tuning into this coverage by Sheen Research, your strategic partner in uncovering untapped business potential.